Hi, in this video I'm recording the first losing trade in this $500 options account journey. So if you've been watching only the winning trades so far, this is the video that actually matters. Today I'll walk through why one loss tells us almost nothing, why the early win rates are misleading, and why the only thing that matters is the expected value of the strategy over a large number of trades. Now, this is where most traders get emotional and where a mechanical approach really shows its value. If you're trading small accounts, this mindset is non-negotiable. So I'm Dr. Ashik Rahman and welcome to Small Account Options Trading. So first, I'll start with my account update, and if you are a screenshot chaser, you'll probably click out of the video after this. But if you really want to learn how this game is played, I invite you to stick till the end of this video. So here is the update so far. So as you can see, in the last day, it was, so remember, this is like a $470 account because I took out $10 away for my personal use. And in the last day, it was about $904. Today, it's about down by a few dollars compared to that $904. Why? Because yesterday it was a little bit more down, but now it says it's like $16 up because today it's up. But I have some account updates to share. So the first thing is good news. I'm recording my first losing trade in this account journey. And what is the position as I predicted, or as we already all of us predicted, that AMAT, the advanced materials position that I had, that one would have to be closed at a loser at 21 DTE. So if I look at the trades, this is the situation so far. The trades here, it's, this red one, this is the first losing trade on AMAT, call credit spread. Now, you might say, okay, what are the lessons that I can learn from this AMAT position or this loss? Because most traders will tell you that, okay, if you make a loss, take notes and whatever, do something, okay, learn from your mistake. Okay, so I'm going to argue that there is nothing we can do. Okay, AMAT is a position that it closed at a loss. You could say, okay, fine, I went in when this account when this AMAT was going higher and higher, making higher highs and higher lows, which means, and it's also above 2 Bollinger Bands, which means 2 standard deviations away from the mean. So the price would probably come back down. Now it might or it might not. I have zero idea. Nobody has any idea if it's gonna come back down. Okay, I got into this trade when it was like about 230 or 295, and it went higher. Okay, it did not come back down. There's nothing I can do about it, and there's nobody that can actually do anything about it. Okay, so I have to take the loss and move on. So now you might be saying, okay, why did I go into a trade that was going higher and higher? Well, I had 2 reasons to get into it. The first reason was that it was like a trading above the second Bollinger Band, which is like 95% likely that it's gonna come back down within that Bollinger Band, but it didn't. Guess is one of those 5% things. And also the other reason was that last time I made this profit on AMAT using this exact same principle, where it was trading above the second Bollinger Band, and I actually made $110. So basically, just this loss actually just canceled out the first profit that I had, which is fine. That's gonna happen. If I was luckier, I'd probably ended up with a profit in this one, just like the first case. In this case, it didn't happen. Just move on. Okay. So the next thing. So as it turns out, if you count all the trades, I have about how many? 1, 2, 3, 4, 5, 6, 7, 8 closing trades. So I closed 8 trades, and 7 out of those 8 turned out to be winners. So what does this tell us? That, okay, I am strategizing potentially very good strategy, which means, I have like more wins than losses. And if I calculate it out, the percentage that people would calculate is like, let's say, what's the percentage of wins? 7 out of 8, which is 87.5% win rate. Okay, is it true? Is it true that I'm this genius that I have this 87% win rate? No. It doesn't mean that I have this edge above everyone else with this 87% win rate. Why? Because I only traded 8 closing trades. Okay, I still have some opening trades on, and I'll put even more as I get more money, but it doesn't tell me that my strategy is a genius strategy. It does tell me that my strategy, my sample size is too small to come to that conclusion that I'm a genius. Okay, why? Because if you want any sort of statistical validity, you need to think about central limit theorem. What does this tell us? It tells us that you need at least 30, if not more, trades to say that your strategy is statistically significant. Okay, so for example, if I actually Google this central limit theorem thing, okay, for you, what is the definition? Just the basic overview definition. Central limit theorem states that the sampling distribution of the sample mean, the average approaches a normal distribution as the sample size becomes large, and for that large, it has to be at least greater than 30. Okay, regardless of the population's distribution shape. Whatever the shape is, if you trade more than 30 times, your like account size will, or your trades will reach the expected value. Okay, so the expected value is given by maths, statistics, and there's nothing you can do about it. It depends on your strategy. If you have a better strategy, it will mechanically give you the expected value over a huge number of trades. Okay, so if you have a small number of small frequent trades, that's when you reach that sample size fast, and that's when you can tell, or I can tell, that my strategy is working, is statistically significant enough for me to be advertising this on YouTube. Okay, so if I look at the images, it's like a bell curve. You all know the bell curve, and if I have a lot of trades, I would have a curve that is basically, it approaches the mean. Whatever that means, you don't have to know. It's just, you have to understand that two things. You have to have a good strategy that has a positive expected value, and the second thing is you have to trade it enough number of times. Okay. So if I have any short-term results, in this case I have like 7 out of 8 closed trades turn out to be winners. This is basically noise. Okay, in the last video I showed you that it is just noise. My account may go up, may go down over the next few trades. It went up, pretty well in the last few trades. It may go down in the next trades. That happens. It's just noise. But over the long term, I know, or we will see that this is a good strategy, and I would end up with at that point, if I end up with this after like 100 and 200 trades, if I have this 87% win rate, or 87 out of 100 winning trades, then I would say, okay, I'm doing a really good job. This is a really good strategy. But also, that's not important. The more important thing is, again, the expected value. So my current goal is to reach 100 trades as quickly as possible. Okay, so I have to trade frequently, and of course that means I need to have more money in my account. So for example, here I started with this $500. I added some. I had added $200, and then I took out like, $230 or $230, and now it's sitting at $470 that I have actually added, and the rest of them are riding on the profits. So if I can add more money, I can have more trades on. So for example, here currently I have how many? 3 winning trades, 3 open trades, and $100 extra left over. So now if I have like $200 or $300 extra left over, I can have like 4 open trades, which means this account size that I'm reaching is going to reach faster and faster. So my goal is already set. This on the left hand side column, as you can see, this is like the number of trades. I have 11 opening trades, 8 of them are closed. My goal is to scroll down and fill up this whole thing, have this whole table filled up with 100 trades, if not more. So once I reach this 100 trades mark, then I can say, okay, my strategy is really good, and hopefully by then I would have a much bigger account size, which would have grown not only because I put in more money here, I put in more capital here. This is the capital column, but also because I actually made profit. So my P&L column would hopefully be more green than red, and the reds are not big. And just remember, this AMAT loss, this $148, this was like one of the worst case losses, right? Just because I closed out at like, 21 days before expiry, that is the reason I actually have this relatively small loss. Remember, I got in at 220, I exited at 368. And that's why getting out at 21 days is super important. So as you can see, my break even was about 295 or 296 bucks. Anything above that, I'm deeply in the money, and I'm basically looking at a huge loss, which I did take. This is like the worst case scenario. I took a huge loss. It's like 295 to 300. 300 was like the leg that I bought. I sold 295, I bought 300. So anything above 295 is basically I'm looking at losses. But because I came out at 21 DTE, my loss is like about 148 bucks. It's not maximum loss. Remember, the maximum loss for a $5 spread, that would be like $280. So instead of looking at this $280, I'm looking at this $150, which is a huge save on the losses. Because why it's important? Because you're gonna make losses. You're gonna incur losses eventually over 100 trades. You're gonna make a lot of losses, and it's important that the losses are not full losses as big as the losses that we have, right? So it's 148 is a really nice or a small loss, because the wins that I'm getting is like about that size, 120, 80, 100. That's a really nice setup, right? So AMAT, that was a good one. So my goal is to have this 100 trades, 100 and more trades reached quickly, or as quickly as possible. And so now I'm focused on the process, and I don't really care about the account balance. Why? Because if you look at this account balance, it's like today it was up to 987, and then it closed at 871. So if I look at that every move, this volatile account, I'm gonna go crazy. I don't really care. Okay, so I have to like wait for this thing to slowly go up, and it's actually going up. If I look at this 3 months progress, it's actually going up. Okay, so again, so look at the big picture. That's like if there's one advice you want to take from this video, look at the big picture. Okay, so focus on the process, not the account balance, and eventually the law of large numbers would play out. It would trump the individual outcome. So for example, in an individual trade, I lost like 150 buck. Doesn't matter, because as I keep playing this, some of the trades losses would be like 20 bucks, 50 bucks, 100 bucks. Some of the wins would be 100 bucks, 80 bucks, 90 bucks, 40 bucks. Okay, and if I have more wins than losses, I'm gonna have a bigger account by the end of the year. Okay, and money follows expectancy, not your emotions. So if you can keep your emotions away from this, just trade mechanically. Just know, I mean, it's hard to keep emotions away when you are actually actively deciding what to do. And since my strategy requires me to actually not like decide whether to get out or get in or not. Like getting in, okay, fine, that's my choice. But getting out, if it's a loss, if it's not a loss and stuff, if I'm worried all the time, then emotions would come into play. In this case, I'm not worried. No emotions come into play. Why? Because I know I'm gonna get out of that position. If it doesn't already automatically get out of the position for me at a profit, I would eventually get out at a loss, and the worst case loss is like 150 bucks, 200 bucks, 280 bucks. No, I'm not gonna get 280 bucks loss. Why? Because I'm getting out at 21 DT. But let's say I get a $200 loss. Big deal, right? Next slide. So as I mentioned, it's important to keep an eye on the expected value, and this is the main part of this strategy. Okay, so the question is, what is the expected value of this strategy? And you have to understand that high win rate, even if I like have 99% or 100% win rate, that doesn't mean that my expectancy is positive. So for example, if I look at a random stock, let's say SPY, okay, most common one, and I actually, let's say, trade option, and I want to sell a put, buy a put, and let's say I go out at 42 days or something, right? If I want to sell a put, right, here, as you can see, it's like 67% chance of profit. That's good. If you want to go for a higher win rate, go for, let's say, this 90% win rate, 90% chance of profit, okay? But, you know, you are paying a lot of money to get into that position. Let's say you want a 100% win rate or 99% win rate. Look at this position. This is like 480 bucks. There is no chance that SPY is going to 480, so you can keep like selling this. The problem is, like, nobody is going to, buy this from you. That's like one of the things. And even if it does, so I'm just going to move myself a little bit here. Look at this. To get this 22 bucks from someone, we're like spending what, 47 or $50,000, $48,000 just to get into this position. So this is going to guarantee you 99% win rate, but it's gonna take like 50 bucks, 50,000 bucks from your account just for being in this trade. And you have to hold that. If I had that $50,000, would I be creating this video? Come on, right? So this win rate, it's like BS. What you need to understand is not the win rate. Even though I have a very high win rate, this is like 87% win rate, is really high. It's much better than all those day traders and technical analysis gurus. But it doesn't mean my expectancy is positive. The question is my strategy positive expectancy? How do I calculate that? It's a simple formula. I'm gonna assume, okay, so I'm gonna open up a calculator and calculate my expected value. Expected value, let's say I have this 87% win rate, okay, and the trades that I win, let's say if I just have a quick look at it, most of my trades are about 95, 100, 97, whatever. So let's say on average I win 100 bucks, okay. 100 bucks is my profit times the my win rate. Let's say conservative is like 80%, okay. So 80% minus, when I lose, it's, how much? Let's say worst case scenario, 150 bucks, okay, times, and I lose like 80, like 100 minus 80, which is like 20% of the time, okay. So if I do that, let's see, is it positive or negative? So as it turns out, it's negative. So is my strategy a negative expectancy strategy? We'll see as numbers play out. But for it to be break even, okay, what I need is for my strategy to, let's say it's like 87% win rate. If it is like 87% win rate as it's showing now, is it positive? No, it's break even. So as you can see, for my strategy to play out over the long term, I need like this 87% win rate minus, I cannot lose 150 bucks. What I need to do is, if I win 100 bucks 87% of the time, actually, my bad, there's a mistake. So 150 times, if the win rate is 87, my loss rate is 13, okay? So if this is the case, if I win 87% of the time 100 bucks and I lose 13% of the time 150 bucks, my expected value is, why is it break even? Am I doing it right? Anyways, I'm doing this on the fly, so don't judge me on my maths. uh, okay, so now it's working. This calculator is working now. So if I win 87% of the time, $100, and I lose 13% of the time, $150, then over 100 trades per trade, I can estimate that my profit is 67.5 bucks. That's my average or expected value. So over 100 trades, I can expect my account size to grow by $6,700. Okay, if I'm doing the math wrong, just tell me in the comments and I'll correct this and actually make a prepared video. This is like out of the blue. I'm just winging it here. I'm just giving you an idea what could happen. Let's say this is like $80, 80% win rate, and the loss rate is 20%. So I'm gonna double check. Okay, even then, the expected value is $50. Okay, so if the expected value is $50, what does that mean? Over 100 trades, my account would be up by $5,000. So if I won $5,000 in my account, assuming that my strategy is this 80% win rate and $150 per loss, then after 100 trades, I would end up with $5,000 extra in my account. Let's see if that works out or not. After like my 100 trades are done, you tell me in my when you look at this video, you can come back and comment, told you so, if my account size is blown. Now, of course, there is also a probability of the account size being blown. So I'm going to show you the detailed calculation in a later video, but that can happen. So this is what happens. So it's too early to say if I have positive expectancy or not. Realistically, I should, but let's see. So what matters in trading is, again, high expectancy or expected value to be positive. I need to have defined risk and consistent sizing, which means I cannot blow my whole account on a single trade. I cannot just, risk it all in a single trade. I have to survive the whole thing. And losses are exactly embedded in this distribution. Even if I take into account the losses, which I completely accept, once I accept those losses, I will be able to move on to the next trade and get that numbers play out in my favor. Okay, imagine buying a slot machine that is in your favor. Okay, now when does geniuses fail? Now the strategies or the geniuses who came up with those strategies fail when the sizing is too big. Okay, if I'm gambling away my full position on a single, let's say I saved like $1,000 with my hard-earned money, I put that everything in one Tesla trade, I would probably lose it all. Even if it is like 99% win rate, that 1% it doesn't win, that's 1%, that's the 1% or one time that it will go against me. I've seen that, I've experienced that, you probably have as well. You'll see that everyone is making money except that one time that it doesn't make money, that is the one time that you are trading it. Okay, that happens. Okay, so don't put all your money in one position. So oversizing actually destroys all the profitable systems, even the most profitable systems like my one, okay, or anything that I'm shown, like 99% win rate. SPY never goes to 480. You put on that trade, SPY goes to 480, 450, okay, and you lose all your money and even your house and your bank account and your wife. So like that happens, right? I don't know why that happens. It's just numbers or it's just God. I don't know why, but it happened to me. It will happen to you. It happens to you. Just tell me if it happens to you. And so one bad trade shouldn't be able to break or make your account, right? So I actually got into a new position today on cold, #cold or $cold. It's a put credit spread. Remember, I went into another cold position before. If I scroll back, so cold on actually this one. So on a couple days back, I went into this cold put credit spread 24.19, and then I went into another cold position. Now, does that contradict my saying that okay, I'm putting my 2/3 of my account in cold? Okay, now that could be a cold hard truth, no pun intended, but again, I don't know what's gonna happen. So now I'm putting my money into cold because I'm confident that it's gonna go up, or at least I'm guessing that it's gonna go up. I'm never confident. I can never be confident. I'm guessing that it might go up. But why am I preaching you about diversification or position sizing and getting into this cold spread? Am I just BSing you? Okay, but one thing is important is like diversification. Position sizing has to be small, and the small positions have to be uncorrelated and diversified. So, given that, why am I into this position? So, as you can see, this cold position versus the other cold positions that I have, they're diversified a little bit. How? If I move myself here, as you can see, this cold position is 2419 and expires on 320, okay, March 20. And this position that I went in today, why? Because cold even down even further. So I thought maybe why not get in. Um, and this one expires 45 or 42 days from now, and it's like March 6th. Okay, so they're diversified in terms of the expiry dates. Okay, so even though they're the same underlying same position, they're just diversified in terms of the expiries, and they're also diversified in terms of the what do you call the strike prices. Okay, so I'm sort of diversified, even though it's like correlated positions. I'm diversified, so let's see how that works out. And you know that's how I'm reducing my risk of blowing it up. Now, the reason I went into cold again, or my reasoning was this, that weather is a high impact variable or an event. Okay, and nowadays we are actually having this historic cold weather predictions, which means the gas prices have risen, and the cold, which is the inverse of gas price, has fallen. So if I look at this chart, the cold chart, here, no, the first let's look at the gas price, natural gas. So gas prices go up when the prediction for the weather turns shitty. So for example, the prediction is that the weather is going to be bad, right? Historically bad. So whenever that news came up, the coal price, the natural gas price went up above this second standard deviation. Okay, and this is like the second Bollinger Band. It's like it went up above the second standard deviation. The next couple of days later, yesterday, another prediction came up that the weather is going to be even worse than what it was originally predicted to be. And then the price went up. Okay, the price went up today, and it did not go up above 5.5. Okay, so the historic bad weather is making this go up to a certain point, and then even the worst case scenario of the historically bad weather is not being able to push this price higher. So I'm guessing that over the next few weeks, 3 or 4 weeks, when the ice starts to melt, the heating, we don't need as much heating. It will just, the price may go down below this second standard deviation. It might not. The weather might turn worse. I don't know. We might get a huge ice age or something for the next 10 years. If that happens, Disney Ice Age movie would make a lot of money and I would blow up my account. That might happen. I don't know. But realistically, I feel like the weather might get warmer, or there would be a better projection over the next month. The price might come down. If the price comes down, the cold price would probably go up to whatever the price was before. So the historic bad weather could not push the price of coal down below $20. Okay, so if prices become better, it might go up. I'm not gonna use the language that is like a gap fill or anything, because I don't believe in that crap. But if you wanna call it a gap fill, you do you. I'm just saying that, okay, historically the price, the temperature may rise and the coal price may go up. That's what I'm guessing. It might happen. I don't know if it will. If it does, I'll probably make like $100 off of each of these positions, right? And that would be a good thing. So That's why I went into two positions. Two of my three positions in my whole portfolio is on cold. Okay. So now, as you can see, I'm watching the weather. I'm not predicting anything. I'm just saying that it's extreme winter. It's driving volatility, and it may forecast the revisions. The forecast might be revised. I don't know if it will. If it does, coal price will go up, uh, and uh, and I might make money. I might not. I'll just take the loss and move on. I could have got into IBIT. Why? Because IBIT is like the Bitcoin thing. Bitcoin. Let's see what the Bitcoin chart is doing. Bitcoin is, again, it's pretty low. Okay. The prices are low. Am I looking at the correct chart? What am I looking at? Bitcoin, US dollar. Okay, this is the correct chart. So the chart is, it's kind of low at the support, if you want to call it support. It's just the price that people are buying Bitcoin at. For some reason, that's the value that people think it's worth. So $89,000, $87,000, $90,000. So if I can get into IBIT, if I had extra couple of dollars, I would get into IBIT. Why is this? Because IBIT would probably go up if the Bitcoin goes up. Bitcoin is not going down, so likely it's not going to go down. I don't know if it will, but if it does, good for me. I didn't get into IBIT. And if it doesn't, I could have just, if I had extra money, I would put into IBIT. It would just go up. Hopefully, I don't know, but it can. Okay, so but then I decided to get into cold, so that hopefully we ride out this weather. It gets warmer, and it will be like sunshines and roses in my trading account, not just the weather. So final takeaway: losses are normal. I just took my first loss just to show you, to point out that I take losses, you have to take losses, they take losses, he takes losses, everyone takes losses. Take losses. Okay, make sure that the losses are small. It doesn't blow up your own account, whole account. Expectancy is super important. It's more important than win rate, and size matters. No matter how much she tells you that size doesn't matter, it does matter, especially in trading, because you don't want to get royally screwed. And finally, most importantly, I'm going to bold this, I'm going to italic this, I'm going to underline this. Mechanical rules protect mental health. The reason I'm still sane, even after all my job and teaching duties, dealing with all the students and my whatever colleagues, my colleagues are great, but like the students, or the duties that I have to do as a teacher, perform as a teacher, teach students, grade exams and stuff. I'm still sane, or mentally sane, whatever you want to call sane, because in this video it might seem like I'm not sane enough, but let's see, if you call this myself, this is sane, then the reason I'm sane is because my account is not blown. I'm not worried because I have this mechanical strategy. Okay, so now the question is, again, if there's one thing to take away from this video, is that individual trades don't matter, only the process does. This, as you can see, this account is about collecting data, executing consistently, and letting the law of large numbers do its job over time. And this is exactly how I wish someone had explained options trading to me when I started. Nobody did, so I'm broke. So I'm teaching you how to do it. So if you want to follow this small account journey honestly, including the wins and losses that I'm incurring every day, consider subscribing. Just stay connected, hit the like button, comment something. That really helps me out a lot. And I'll see you in the next update on my account next week. All right.